People say cash is paying again, and then they ask the same question. Should I park money in a money market fund or buy Treasury bills? They both feel safe. They both throw off interest. And the difference can look tiny. By the end of this video, you'll be able to pick the right one for your timeline, and you'll know exactly which screens to check, so the yield you see is the yield you actually keep after taxes and fees. Picture this. You've got about $20,000 sitting for a future expense. Maybe it's a home repair, maybe it's tuition, maybe it's just your emergency buffer. You want it liquid and boring, but you also do not want to leave real money on the table. Here's the first thing to get straight. A money market fund is a fund. It's a pool of very short-term debt, and it tries to keep the price steady. A Treasury bill is a specific government security with a fixed maturity date. You buy it at a discount, and it matures at full value. That sounds like two versions of the same thing. It isn't. Start with how the rate behaves. A money market fund's yield floats. It moves as the fund's underlying holdings roll over and reset. When short-term rates move, a money market fund usually follows, often quickly. A Treasury bill locks. If you buy a 3-month bill today, you effectively lock that yield for that term. This is why people misread the situation. They compare today's fund yield to today's bill yield and assume that difference will stay. It will not. One is a moving target, and one is date certain. Now, let's make it concrete with simple math. Say you put $20,000 into something yielding about 5% per year. Roughly, that's around $1,000 per year, or about $83 per month before taxes. That is the easy part. The less obvious part is what you pay to earn it, and what taxes do to it. With a money market fund, the first leak is expenses. Even if you never see a fee line item, many funds have an expense ratio. It is taken out of the yield you see. So if a fund advertises a 5% yield, that already reflects the expenses. But it also means you should not compare it to a bank account without checking the fee structure and the way interest is calculated. With Treasury bills, you usually do not pay a fund expense ratio, but you can still pay a spread depending on where and how you buy. And you can face price movement if you sell before maturity. If you hold to maturity, the path is simple. If you might need to sell early, it becomes a market price story. So, the first decision variable is your timeline. If you truly need the cash on a specific date, a Treasury bill that matures near that date can be a clean match. If the cash is an open-ended buffer and you want to stay liquid without managing maturities, a money market fund can be simpler. Now, bring in the tax twist. This is where same yield stops meaning same take-home. Interest from United States Treasury securities is generally exempt from state and local income tax, though it is still subject to federal income tax. That can matter a lot if you live in a higher tax state. A money market fund may hold a mix. Some funds hold mostly government obligations. Some hold repurchase agreements or other short-term instruments. And the part of the fund's income that is attributable to United States government obligations may be eligible for state tax exemption, while the rest is not. That means your after-tax outcome can vary fund by fund. This is the line item people miss. They look at a yield number and forget that the tax treatment can change what you keep. Let's go back to our $20,000 example. Assume you earn about $1,000 in interest over a year. If your state tax rate is around 5% and your interest is fully state taxable, that is about $50 gone to state tax, before you even think about federal tax. If the interest is exempt from state tax, you keep that $50. On $20,000, that difference can beat a small yield gap. Now the practical question is, how do you know what is taxable in your state? You do not guess. You check. For Treasury bills, the check is straightforward. Your brokerage tax documents will show interest from Treasury securities. For a money market fund, you look for the fund's year-end tax information, often called a supplemental tax letter, that shows the percentage of the fund's income derived from United States government obligations. That percentage is what many taxpayers use to determine the potentially state-exempt portion, depending on their state's rules. If that sounds annoying, that is the point of this video. You only have to learn the system once. Here's the second thing people misread. Money market is a category, not a guarantee. Different funds take different risks. Government money market funds generally hold government-backed instruments. Prime money market funds can hold short-term corporate credit. They still aim for stability, but the risk profile is different. Treasury bills are direct obligations of the United States government. That is a different kind of safe than a fund holding a mix of short-term paper. So, the second decision variable is what kind of risk you are actually trying to avoid. If your main fear is credit risk, direct Treasury bills are the cleanest version of backed by the government. If your main fear is price volatility and you want a stable account-like experience, a government money market fund can feel smoother day to day. There's a counterpoint worth saying out loud. Some people hear Treasury bills and assume they are risk-free no matter what. If you buy a bill and then sell it before maturity, you can get a price that is slightly higher or lower than what you paid. Usually it is small for short maturities, but it is not zero. So if you truly need same-day liquidity, selling can introduce a tiny bit of variability. On the other side, some people hear money market fund and assume it is basically cash. In normal conditions, it trades like that. But it is still a fund, and you still have fund rules, settlement timing, and a specific set of holdings. So, the practical way to frame it is simple. Treasury bills are date certain if you hold to maturity. Money market funds are convenience certain if you want to stay in cash-like yield without managing maturities. Now, let's turn this into a decision you can actually make in 2 minutes. First, decide if you have a date, not a vibe, a date. If you need the money on a specific month, like, I need this in late May, Treasury bills are built for that. You can buy a bill that matures near that month, and you're basically matching cash to a deadline. You are not waking up wondering what the yield will be next week, because you already locked the deal. If you do not have a date, and this is, I want to earn something while I keep my emergency fund accessible, then a money market fund is designed for that kind of parked cash. It will float with short-term rates, and you can generally move in and out easily inside a brokerage. Second, decide how sensitive you are to the tax twist. Here's a clean rule that is not financial advice, just a way to frame the trade-off. If you live in a state with meaningful income tax, Treasury interest can have a built-in advantage because it is generally exempt from state and local income tax, while still taxable federally. That is not a tiny detail. It can be real money. If you are using a money market fund, you do one extra check before you trust the number. You find out whether it is a government money market fund and what % of its income is from United States government obligations. That tells you whether you may get some state tax benefit, depending on your state's rules. Third, decide how much you hate managing maturities. A Treasury bill ladder is powerful, but it is still a system. If you are willing to do it, you can roll bills every 4 weeks, 8 weeks, or 13 weeks, and keep cash coming due regularly. If you hate that, the money market fund is convenience. Now, the 3 signals to watch so you can tell when the better option flips. Signal 1, the yield screen you are actually using. For a money market fund, look at the fund's 7-day yield and the expense ratio on the fund page. The direction that matters is whether the 7-day yield is moving up or down over a few weeks. Timing-wise, money market yields usually follow short-term rates with a lag as holdings roll over. For Treasury bills, look at the specific maturity yield quote, like 4-week, 13-week, or 26-week on your brokerage or the auction results. The direction that matters is whether the yield for your intended maturity is rising or falling, because that changes the lock you are getting. Timing-wise, this can move day to day. Signal 2, your state tax exposure. This sounds boring, but it is the sneaky winner. If your state taxes interest, then a Treasury-heavy option can win, even if the pre-tax yield is slightly lower. The timing is annual because you feel it at tax filing, but the decision is now. Signal 3, your need to sell early. If there's a chance you'll need the cash before maturity, that makes money market funds more attractive for the no surprises experience. If you are confident you can hold to maturity, a Treasury bill gives you a clean, date-certain payoff. Timing is immediate, because the moment you sell early, you turn locked into market price. Now let's revisit that $20,000 scenario one last time. If this money is for a date, like a planned expense in 3 months, a Treasury bill maturing around that date is the clean match. If this money is for unknown timing, like a true emergency fund, a government money market fund can be the simplest way to earn floating yield without managing a ladder. Here's your 2-minute checklist. If you do nothing else, do these. 1. Write down whether this cash has a date or not. 2. Pull up your brokerage and look at the 13-week Treasury bill yield because it's a good reference point for short-term cash. 3. Pull up the money market fund page and check the 7-day yield and the expense ratio. 4. If your state has income tax, make a note that Treasury interest is generally exempt at the state level, and then find the fund's year-end tax info so you know whether the money market income is mostly Treasury-based or not. 5. Ask yourself one honest question. Could you need this money before the bill matures? If yes, you are buying convenience, not just yield. If you can answer those 5 items, you are no longer guessing. You're matching a tool to a timeline, and that's the whole game. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns, and leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler.